Welcome to The Explainer. Today, we're putting Pediatrix Medical Group through the absolute ringer. We're taking the cold, hard data and running it through the legendary investment frameworks of the world's greatest financial minds to see if this company is a hidden gem or if it's just a value trap. Here is our game plan. We'll grab a quick company snapshot, then run it through the gauntlet. The Buffett lens, the Lynch lens, the Graham lens, some hardcore DCF math, and finally, we'll wrap it all up with our overall synthesis and verdict. Let's get right into it.
All right, part 1, Company Snapshot. We are looking at Pediatrix Medical Group, trading on the New York Stock Exchange under the ticker MD. Right now, shares are trading at $22.47. That puts their total market cap at roughly $1.8 billion. So they're a very solid mid-cap player in the healthcare space. But, what's actually driving that value?
Well, they do something absolutely essential. They provide highly specialized physician services for the most vulnerable patients out there. We're talking nearly 5,700 employees globally, covering about 25% of all U.S. NICU beds. That is a massive footprint. When a hospital needs top-tier, high-risk obstetric or neonatal specialists, they usually contract with Pediatrix. It's an incredibly specialized, asset-light, and critical business.
Moving on to Section 2, the Warren Buffett lens. Here, we're hunting for wide economic moats, solid management, and pristine owner earnings.
So, does Pediatrix have a moat? Actually, yeah, a huge one. It's built on a mountain of data, longitudinal data from over 1.6 million neonatal patients. Add in these multi-decade hospital contracts, and you've got a fortress. Think about it. If you're a hospital needing 24/7 specialized care, switching providers is just way too risky. Those high switching costs, that is exactly the kind of moat Buffett drools over.
And the numbers totally back it up. Looking at Buffett's checklist, they are rocking a stellar 20.89% return on equity. Sure, there's about $630 million in debt, but with an EBITDA sitting over $261 million, that debt-to-EBITDA ratio is around 2.28. Totally manageable. But here's the real kicker. Owner earnings. They are churning out over $237 million in free cash flow over the trailing 12 months. Buffett absolutely loves a cash printing machine, so for the Oracle of Omaha, this is a solid pass.
Next up, Section 3, the Peter Lynch lens. Let's talk categorization and some of the hidden dynamics going on with the stock. If Peter Lynch were looking at this, how would he categorize it? He'd probably call Pediatrix a turnaround that's shifting into a stalwart. They've been busy restructuring lately, dropping underperforming ambulatory practices to double down on their core hospital services. Basically, they're trimming the fat to protect their margins.
Now, check out this number, 0.86. That is their PEG ratio. We get that by taking their PE of 10.88 and dividing it by their historical earnings growth of 12.6%. For Lynch, a PEG under 1.0 is the holy grail. It means you are literally paying less for the stock than its earnings growth rate. Mathematically speaking, it's undervalued.
But hold on, because there is a massive red flag here for Lynch. Institutional ownership is sitting at a crazy 105.4%. Now that happens because of short selling and mutual fund overlaps, but Lynch hated crowded trades. He wanted those hidden, undiscovered gems. Plus, insider ownership is tiny, just 1.59%. So great PEG ratio aside, this highly crowded trade makes it a solid hold for a strict Lynch disciple.
All right, Section 4, the Benjamin Graham lens. Time for the strictest test of them all, the defensive investor's checklist.
Graham is notorious for demanding a bulletproof balance sheet. And honestly, Pediatrix stumbles a bit here. They pass the size test with that $1.8 billion market cap, and their earnings are definitely stable. But their current ratio is only 1.33. Graham wanted to see a 2.0 or higher, meaning short-term liquidity just isn't as ironclad as he'd like. There's no dividend either. They do barely pass his multiple test, though. PE multiplied by price to book gives us 22.3, squeaking just under his strict maximum of 22.5. So let's do the math on Graham's famous intrinsic value formula. You take the square root of 22.5, multiply it by the EPS of $2.06, and then by the $10.96 book value. Run those numbers, and Graham's fair value lands at exactly $22.54.
And here is the problem. With the current price practically hugging that fair value, there is almost zero margin of safety. None. Graham usually demanded a 30% discount before he'd even consider buying a stock. So without that cushion, He would absolutely pass and just wait for the market to tank.
Moving right along to Section 5, DCF and quantitative models. Let's run the mathematical gauntlet and ditch the philosophical gurus for a minute.
Let's build a discounted cash flow model. Radical transparency here. We are starting with that massive $237.32 million in trailing free cash flow. We'll use a super conservative 3% growth rate, mostly because they have flat revenue guidance and are facing messy regulatory hurdles like the No Surprises Act. We'll cap it with a 2% terminal growth rate and discount it all back to today using their stated 7.09% weighted average cost of capital.
When we crunch those numbers, our base case spits out a fair value of $50 a share. And look, even if we stress test this with a brutal 8% discount rate and tiny terminal growth, the model still points to $38. Both scenarios are way above the current $22 stock price. The sheer cash generation here is just undeniable.
To double-check our math, let's look at the enterprise value to EBITDA ratio. Pediatrix is sitting at a super low 8.04 times. The rest of the healthcare service industry, they're averaging around 11 times. Just to reach peer parity, this stock should realistically be trading up near the $30 mark. Finally, Section 6, Synthesis and Final Verdict. Time to blend all these frameworks together and figure out what it all means. Here is our ultimate scorecard. The math? It absolutely loves this stock. Both the DCF and the EV/EBITDA models are screaming buy. Warren Buffett would be totally on board with the deep moat and the heavy free cash flow. But Lynch and Graham, they're saying pump the brakes. Lynch hates how crowded the institutional ownership is, and Graham won't touch it without a much wider margin of safety on the balance sheet. So what it really boils down to is this trade-off. On one side, you have a massive 13.1% free cash flow yield and a company that practically runs a quarter of the U.S. NICU beds. Incredible strengths. On the flip side, you've got serious risks. Margin compression from Medicare and Medicaid, and some really complex regulatory billing headaches. Which leaves us with a pretty provocative question. If the pure math screams buy, but the strictest defensive checklists say wait, does Pediatrix meet your own portfolio criteria? How much weight do you personally put on a company's raw cash printer versus the absolute safety of its balance sheet? The gurus are split, the math is totally bullish, and the true value? Well, we'll see what the market decides. Thanks for joining this explainer, and keep testing those assumptions.